Hey traders, what's going on? Jamie Settler here. This is the free webinar here on March 5th, 2019. And we'll get started here in just a few minutes. But before we do, let me know, please, that you can hear me and that you can see the screen. We've got a couple, the DXY weekly chart and daily chart up at the moment. Just want some confirmation that you guys can hear me. Ellen C says, Pete, I'm guessing that means loud and clear. So we are good to go. All right. Give me just a couple minutes, let the room fill up for a bit here, and then we will start. So sit tight. Go grab yourself a coffee or a water or a beverage if it's happy hour where you are, and we will start in just a bit. All right. All right, so let's get started. All right, so Jamie Sedley here with SB Trade Desk, and we are going to look at, give you a quick rundown. First, I see some familiar names here, of course, some members, and we, of course, will be doing another webinar in the morning, but I also see some names that I don't know, so welcome. And just quick heads up, we do have in 25 minutes Australia GDP, and we know we have the Aussie dollar sitting in kind of an interesting spot, sitting right at the bottom of the range. So we will look at that here in just a bit after the number comes out and see if there's anything to do. All right, but first off, we're going to take a little longer term look here. I want to look at, we're going to start with the dollar. It's always a good spot to start. This is DXY, right? The popular, very popular, most popular dollar index. It's mostly euro, so it's not, completely representative of the dollar. A couple things here. We want to look at, one, we have the 200-week average sitting right under price. Okay, it's been like this really since, I'd say, August, maybe even May, or last June, but really August, where we've come into an area on DXY where we've kind of been looking at this as a possible inflection point. So it's been quite a while. I mean, you're talking back, since last summer, right? So we're going on, you know, we're going on, something just happened there, but we're going on we're going on half a year, 6 months here almost, right? Where we have been kind of topping or just consolidating in DXY, right? Before we make our decision, right? Before the market makes its decision which way it wants to go. That kind of leaves a uncertainty as to whether we should be looking to be dollar bullish or bearish, of course. Shorter term charts, we've just kind of been trying to trade levels lately because frankly, this consolidation, under this level, right? You've got really good slope, kind of longer term resistance. 618 of this entire drop from 2017 down is just above the highs that we had back in December. And also we're sitting on the 200-week average. And, I've heard this on Twitter a lot. It's like, well, the dollar, if it's going to break down, it already had a chance to do so. At the same time, if it was going to break higher, it already had a chance to do so. Well, true, and at the same time, not true, because simply the consolidation has continued to go. All right, and we are, quite frankly, just sitting here waiting for something to happen. Now, I want to bring in a different chart. This, not a huge Bollinger Band guy, but this is a chart this is just the price chart, okay, weekly bar chart here of DXY, and the bottom indicator is Bollinger Band width, okay, so subtraction, the top Bollinger Band and in the bottom Bollinger Band, and the difference between those two gets you Bollinger Band width. When a market is in a trend, right, range expansion, you have wide Bollinger Bands, okay? It's not that useful until you get to extreme points. When the indicator is extremely subdued, like really low, like it is right now, that means you have extreme range contraction. Well, extreme range contraction is typically followed by an extreme trend. Okay, not always, but when we're talking about in this case, we're getting to the point where this is kind of ridiculous, and we should be kind of on guard for a massive move. All right. So what we were showing here is, and I have it, we're not including the current week because it's still underway, but if we look at last week's reading, the bandwidth was 0.0209, okay? So I have that here. The only times in history that's been smaller, of course, a period back in 2014 that resulted in this gigantic move higher, right? One of the strongest, most consistent trends that we have ever seen in the FX market. And we have to go all the way back to periods back in the 70s where we saw volatility that subdued. All right. In those cases, we ended up having kind of crashes almost in the dollar for at least several months, if not longer. So this is not a directional indicator. It's not telling you that, the market or in question, in this case, the dollar index is poised to break to one side or the other. It is telling you that we are in conditions are present where we could see a massive move take hold. So I'm not trying to guess which way this is going to break. If we were to break higher, I mean, that would be painful for a lot of asset classes. I'm pretty sure of that. Look, we've seen lots of moves back and forth in crude oil, in metals, certainly in emerging markets, pick your poison, China, Brazil, whatever. And we have not seen the dollar really do a whole lot during that time period. So whichever way this decides to go, I think is going to have the answer for, or decide kind of for those other markets, which way those markets go. So all I'm saying is be aware of the current conditions in place from a volatility standpoint. We're coiled, right? Go back to your old physics class. We've we've built a massive amount of potential energy, and that eventually will become kinetic. And when it does, look out, because this thing's going to go one way really fast, in my opinion. If we go back to the euro, which again is about 57% of DXY, we've never seen the Bollinger Band with this low ever. Even back before we, when we broke out back here in 2014, right? I remember that, and it's crazy to think that was 5 years ago, but I did not think that we'd ever be in this low volatility period again. So I don't know. It is what it is. Blame central banks, blame whatever you want, or don't blame anybody, and just realize that we are back in this period where, the markets have gone completely silent, and we are going to get an extreme move one way or the other. All right. Now, I will look at individual currencies here in a little bit, but I just kind of wanted to lay the groundwork for what we are viewing at the moment, understanding the conditions in place for a trending move to take hold. Okay, so back to DXY for now. All right, so here's the weekly. Let's look at the daily real quick. Daily chart might be a little messy, sorry about that, but what we're looking at here is we've drawn a channel. We're big with channels here at SB, and markets move, the way I describe it, markets move between support and resistance, but support and resistance is not always a horizontal support and resistance, right? So a lot of times you get someone say support and resistance, this is support, this is resistance. Markets goes like this, right? That's not really the case. Markets tend to trade between support resistance, but on a plane, in other words, on an angle. And in this case, since the Feb low of last year, right, February 16th, we have the market trading on an upward plane. A lot of times, those angles are defined by what we call the original angle or the original slope. So in this case, you're just, draw off the Feb 16 low and the April 17th low, extend it to the next high, and you have your parallels to work with at that point. So you can see here just how well that has worked out. The market's been trading, really, especially since this year started, since 2019 started, which we call this 25 line because it's 25% up from the lower parallel, but 25 line midpoint, 25 line midpoint, 25 line just last week on Friday, and now here we are back at a level not quite back to the midpoint, but that would be a level I'd pay attention to if we were to get up there. So we're getting shorter term in nature here. But yeah, at some point, this market's going to break out of it. Frankly, if we were to say that the dollar has really rolled over, like for real, and it's, all systems go on a dollar breakdown, you really do have to break through the line off of the February and April lows from last year. Okay, that's going to be all the way down here. As it stands today, that's 94.80. Obviously, this being an upward sloping line, it increases with each day. So, if that happens, when it happens, we don't know, but it could be well higher, okay? And there's no saying that we could not go higher before that. I'm just trying to get you an idea of what we're looking at in the near term. Okay, if we were to get even shorter term here, then we could say that we did hit some resistance today from the close of February 15th, which is the high day of that move. This is another technique that we use called high day close, low day close, or daily reversal resistance and support. And if we were to pull back from here, your support would actually be the low day in the close of that bar, which is right here. That would be 96.22. This will be much better illustrated when we look at the euro, which has actually been a bit weaker than DXY has been stronger. That's another thing that has been prevalent throughout the last, really the last year or so, is the divergences between DXY and euro on both sides. We've seen periods where DXY has made a high or a low and euro has not made a low or high, and vice versa. Judging by where we are with the euro, closer to the low than DXY is the high, I have a feeling we might get that yet again. All right, so let's now go to a different index. We're going to look at US dollar. This is the FXCM Dow Jones Dollar Index. I actually like looking at this one better in terms of its being representative of, general dollar strength and weakness, because it's just a quarter each of Euro, Pound, Aussie, and Yen. And it's not so reliant on the euro. So you get kind of a better representation of general dollar weakness or strength. And in this case, we're drawing just a channel all the way back to the 2011 low. All right. Real simple stuff. And if you zoom into this, you can see the parallels associated with this and all the wicks that are on it. This is a weekly chart, all the wicks that are associated with this. So when we topped here in mid-February, we were kind of thinking that maybe we had a secondary high in the dollar. That has yet to be resolved, right? We just don't know. We are sitting here within this range, and it's kind of the worst time for, say, a trader to position for something right here, because all the options are on the table, right? We don't know. We are not sure. In this case, you'd be looking at bigger support down here, which would also be the 200 week at this point. But if we continued higher within this, which it still is an uptrend, by the way, if we continued higher within this, there's really no telling. You could go back and try to double top with this up from the December 2016 high. At that point, you'd probably be looking at the center line as well. So, just having this kind of gives you context of where, inflection points might be at some point. It tells you nothing about where you are going right now. All right, so make that quite clear. Okay, so let's move on. Dollar, not a whole lot of clarity, right? Let's go to euro real quick. Actually, before we do that, I want to look at the German 10-year, US 10-year yield spread, because this is a chart I followed for quite a while. If any of you guys were, viewed the early January presentation I did with the MT4 Trader Fest, this was one of the charts I showed, and this was kind of an argument for a higher euro. This is, again, German 10-year minus US 10-year. Look, if you that's what currencies tend to move on. I shouldn't say that, actually. Currencies and yield spreads tend to move together, right, on the same forces. So if we look at this, just compare euro to it, you get the idea, okay? Are they always the same? Of course not. Do they tend to move together? They do. It turns especially, and we had the latest big turn in the spread back here in late October of 2018. Of course, the euro ended up following a couple weeks later in November with a low, and you can see this chart here, this construction. You zoom in. This is a weekly chart. If you zoom into this, you can kind of see the seeds being sown for a bigger low, right, or a bigger bottoming process. That's what needs to get going, I think, for you to have like a real fundamental argument for any sort of euro strength, right? As it stands now, we don't have that. This could turn out to be a whole lot of things. That's another big thing in trading, is just because you see a pattern, or I shouldn't say a pattern, but a potential pattern, right? This pattern's not completed really until you break over these highs, this bottoming pattern. Until you see that happen, this could turn into just continuation of weakness. It could turn into just a bunch of sideways action. So don't see it and say this is a head and shoulders bottom, because it's not. It's a potential head and shoulders bottom, right? We don't know how it's going to resolve. That goes with trading anything. You don't know how that market's going to, you can't tell the future. You don't know how that's going to end up, resolving. So do not pretend as if you do know. You'll see what you want to see. That's a human thing. We all do. But at this point, there's a lot to be resolved. So it's hard to make the case that you know, there could not be a surprise, right? So that's one thing, but at this point, that's simply fantasy. So from a actual analysis point, actual trading point, you need to see us get up through that high in that spread, which at this point is going to be about minus 240 on the spread, right? When it's negative, it means US 10 years yielding more. So minus 240, and then you could make a case that you've actually got a big bottom in that spread. All right. Let's go now to, we'll bring in an actual Euro chart. We're looking at daily. This is one of the charts I published today for members. So some of you that are here are members, and you will obviously see that this is familiar because you probably already read the post. But what we're looking at here is daily Euro chart. The 2017-2018 line. So, right, first day of 2017 was a low. We had a low in 2018 at on November 12th. I consider this line valid because it was support on 124 right here. It was basically support a couple ticks below it on 1214. So you've hit it now, you know, 2 months where you made the lows on it. Well, now we're back below it. That's a big spot for me. Okay, as long as you're below that, it's really hard to make a bullish case for the euro. Okay, other than just being like, I'm going to be contrarian and say screw it. There's really nothing else to say other than this is probably, you know, this is a bearish condition. What I'm wondering, and I look at patterns and kind of, especially Elliott wave patterns in an isolated state, if that makes any sense. Like, I'm not trying to say and fit everything together, you know, and say, well, you know, back in 1970, we were in a wave 3, which means now we're in a wave B. No, like, to me, this June high up here from last year, from that point forward, you've got a down leg, an up leg, a down leg, an up leg, and now you're going lower again. 1, 2, 3, 4, 5. If you wanted to get, you know, real Elliott textbook about it, you would call this a diagonal, right? Or a wedge for the classical chartist. This is simply a contracting move, right? It's contained by 2 contracting lines on a diagonal basis. It's also all overlapping. So this low is below this high by a lot. Even the legs within it are overlapping, right? Even this third wave would be overlapping, okay? That's a condition or a guideline of ending diagonals or diagonal patterns. So what that tells me is that I'm going into basically the rest of this week looking at this maybe 113.55, 113.70 area as resistance, right? And, you know, then maybe looking for extensions lower into this next barrier, which is simply a line connected off the lows from November 7th, 2017, okay? August 2018 and November 2018, and that line comes in around 111.20 or so, which is also the support shelf from back in May of 2017. So we're kind of looking at 2 levels here. All right, 1355, maybe 75, whatever, you know, give yourself some room, 55.80, and then down here towards the low 111s. So we may yet be ready to make a move to the downside. Now, go back to what I was talking about with how coiled the market is with that Bollinger bandwidth, right? This isn't a program, this isn't a system. I'm just trying to pick a spot where I can make a bet. And if I can make a bet up here, right, and get some resistance back at this level, which I've deemed important based on the analysis, then I can target this area. It doesn't mean I have to target the whole thing at this area. It means I target some at this area. And if we get here, I'm going to look at the sentiment, which no doubt is going to be terrible. You know, you look at shorter term sentiment, DSI is already in the teens. It has been for quite some time. COT, which is not completely caught up yet, because when the government shutdown, they did not update COT for a while. So they are working on getting caught up, and I was told that they will be caught up by the end of this week. So we should be back on track. But you know, you still have a pretty elevated dollar long position and euro short position when it comes to that. Anyway, keep it simple. We're just looking at these two levels. Okay, that's it. All right. So there's euro for you. That's what we're looking at here at SB for the next well, until it stops working, I guess. All right, let's go to cable. Do have, let's see here. Go back to a little longer term chart here on cable. So one thing that you're going to notice when I'm going through some of these FX charts is that I am kind of all over the place on the dollar right now. And it actually, I think it kind of makes sense to be that way because of the consolidation that we're in. Like, we don't really know which way it's going to break out. We kind of have to have ideas for both sides at this point. So one thing that I don't think can be really refuted is the importance of the 50-week average, especially over the last couple of years. You know, I mean, go all the way back to 2013, 50-week average here, resistance, consolidate around it, broke higher, right? 50-week average broke below, went to a downtrend. You know, the Brexit spike before the actual Brexit was, you know, it was the night of Brexit, of course. And then even last year, right? Broke above it, consolidated into it, went higher, broke below it. Okay, last June, found resistance on it, went lower. Resistance earlier this year in January. Okay, and now we're back above it. So I have a kind of a keen interest on cable, potentially from the long side. You know, if we can pull back and show some support around 31.30 or something. You do have the potential, you know, head and shoulders here. Okay, the big low, right? Breakout, but I wouldn't really consider that a big breakout considering last week we pulled back from the highs and closed well off those highs. If we're looking at a shorter term chart, say a daily chart, I'll actually draw in what we're looking at right here. So this is a pitchfork. What we're looking at would be something like this. All right. So here's the fork, okay? Here's the center line. If you even go, let's go even a 4-hour chart. All right, now we're back. Okay, we're on log scale now, so we're good. Log scale, not log scale, log scale. All right. At this low of a time frame, it really doesn't matter a whole lot. I see Aussie employment just came out. Haven't seen the number. I'm guessing it's not good because Aussie just took a little hit. But not a whole lot happening. Frankly, we're down 16 pips. It's the FX, the way of FX right now. Not huge moves. See what happens. If we can hold the lows down here, I'd be looking to buy it, take it back to 71.50. We'll see. All right, so here's the cable chart, near-term chart. You can see the parallels within this fork. Okay, we actually have held one today and kind of be looking for support back there around 31.10. Resistance up here at 32.50, which is where you opened the week anyway. So I'd be looking to trade range here for the next day or so, maybe the rest of the week. Kind of the story of FX lately anyway is trading range, but That's what we're looking at. But I'd also look at it with within the context of the fact that you might have, we might be within a bigger uptrend at this point, right? Like you had this breakout, but you pulled back, doesn't mean it can't go for it again. So I think with cable, you kind of have to look to buy weakness after the move that we saw through the highs, and you have the construction for a bigger lasting bottom, right? This is nothing to say about Brexit or fundamentals or whatever. That's not really my thing. I'll leave that up to people much smarter than I am, but that's how I'm looking at the British pound right here. All right, let's take a look at dollar yen, because that is most certainly a very interesting spot right now in FX. We've been melting up, right, especially since last week. We had a big up week, but since the flash crash on Jan 3rd, Jan 4th, really, trading day of Jan 4. But this might be where one of the better opportunities exist for 2019. So we're looking at this here. Here's a 50-week average. Throw a 200-week on there because that's where we are right now. So we're right at the 200-week average. I'm looking at kind of everything from the low back in June of 2016, since Brexit actually, as a triangle, okay? So far, that's what it's proven to be. You've got this contracting price action. That's kind of the definition of a triangle. So, wave up A, B, C, D, flash crash. And now we're looking for a wave E high to complete the triangle. That's 5 waves within a triangle. So whether or not we are topping up around here, which is the 200-week average, zoom into this, you can see that you've got old lows over here, which we haven't quite hit, but kind of former support, right? Back in 2018, late 2018, November and December, you've got 112.30, 112.20, that area, which is right where the 200-week is, or whether or not you want to try for a bigger up to 1320. One tendency of E waves is that they kind of tend to make people batty, and you've seen this, I think, with what's happened lately. Is there's been a lot of people kind of looking at banks and bank notes, all that, looking for a big drop in dollar yen. You even have people from the BOJ, former people in the BOJ, looking for calling for 94. Right, crazy things like earlier this year, and the market tends to do its own thing, right? And it just goes the other way, and it makes people look stupid. But I'd be looking at, maybe even 113.20. I don't know if you can get up there at some point, but you might later in the year. And bottom line is, we're looking at this as being, much closer to the end of the consolidation in the grand scheme of things, and then you might actually get that move down to the 94 area. Right, that 94, 95 area, by the way, would be a 618 of the entire rally from October of 2011. So, that's we're looking at a pretty big move, potentially from up here. Whether it's from here or whether it's from 1320, it's kind of splitting hairs when you're looking at a big weekly chart like this. All right, we won't look at 10-year yield right now. We'll look at that in the S&P and the Shanghai Composite and all that stuff in a little bit. But first, we want to take a look at Aussie, which they did just release employment numbers. So, and they're not acting great, 70-60, but, not terrible either. Let's see. All right, so here's a weekly of the Australian dollar. So just like I talked about with DXY and looking at original slope here is pretty clear, right? You're looking at the highs from 2011 and 2013, and that's the trend line. And that's kind of defined a lot of where the pivots have come from, or a lot of good places to at least, put on a trade. So we look at it in this way. I actually think the flash crash low that we had in January, early in January, was a pretty big low, based on one, just hitting this, slope level. Two, based on the horizontal level. I mean, that's the old high from 1999. Okay, you can see a lot of decision points around there. If we zoom into kind of a shorter term chart, go to a daily chart. Trying to resolve this head and shoulders to the downside at the moment. Even if it does end up resolving to the downside, I'd be looking at this trend line from last year, which you can see is very well defined. Right, even periods back here in December and late November, I'd be looking at that as kind of an area to pay attention to. So don't really like to draw fibs off of spike lows like this, but if you were to get a move down to this line, guess where you'd be? 69.50. Guess where that is over the next couple of days? It's right on that trend line. So that could be an area to target. Kind of tough to say. You had a lot of chances to break this, but looking like if you just draw something over today's high, it's probably where the risk is at this point. Generally speaking, this, I would say more 70.55, which actually, by the way, is where we opened the year, to 70.80. You can see that range all the way back to October of last year, right? Consolidation base, big rally, consolidation, flash crash, okay? Bounce, 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 consolidation. We might be looking for a move all the way down to 69.55 over the next couple of days. So after I finish this webinar, I might be sending out some trades. Who knows? We did just hit 70.54. That's the yearly open. We'll see if we stabilize. All right, let's look at dollar CAD, and then we'll look at some equities, or the equity indices, I should say. Okay, so dollar CAD. Oh, that's the wrong chart. All right, here's dollar CAD. All right, so you got BOC tomorrow. This is a chart I did show, weekly chart, back with that MT4 Trader Fest deal. I'm looking at this as you've got a 1-2. This is back to 2011. 1, 2, 3, right? Big third wave extreme, big three wave drop in 4, maybe a leading diagonal in 1 of 5. And since then, we've come off some, have hit support near the 200 week. And I'm looking at us heading into tomorrow is being in a really interesting spot, because here is, all right, here's the high. You'll see this on the daily in a second, but here's the high from June of last year, and that's going to be, what, 33.86. We're just about there. We're currently 33.60. If I look at the daily chart, all right, this is the chart we've been following for a while. We're just drawing a channel here, okay? Channel from the 2017 low, extending it off the high from 2018. And guess what that did? It hit the 2019 high, or sorry, 2018 high, or 2019 high, because it was December, last couple of days of December, first couple of days of January. And since then, if you can kind of pay attention to this right here, we've come in and we've actually traded a lot around this center line right here. Okay, so here's the center line that was support in early Jan, support here on the 28th, right? Traded around it, resistance back here on the 22nd, surged above it when you had that terrible GDP figure on Friday. I believe it was GDP. Again, I'm not a fundamental guy, but I think that's what came out. And I'd be looking at this line, the center line right here, the thick gray line, as support. I don't know if you're going to get it, but if you did, right, if we came back into this area, that's where I'd be looking to buy. In the meantime, we're getting pretty close to 33.86. That is a parallel within this as well, and that's where I'd be looking for some resistance in the interim. By the way, that's also 2 legs up to the tick, 33.84 basically, okay? So big spot there. Be looking for a pullback from that point. And that is the story on dollar CAD. All right, let's look at some bigger macro stuff here. We're going to look at the 10-year yield. Here's the daily chart, 10-year yield. I guess you could scroll out, look at a weekly of it. Let's see. So it's the 38-year channel, okay, back to 1981. And we topped on it back in October, okay? So here we are now. The area where I'm looking for resistance here is essentially up around 281. We're currently 272. So, you know, that's going to be the lows, former support back in July and August of 2018. You've also got a parallel up there that was resistance all the way back in parts of 2008 and 2010. So you've got a lot there. That's just kind of a point at which I'm, you know, kind of honing in on. Funny enough, this is the exact level we talked about during the MT4 Trader Fest webinar all the way back in January, and we still are looking at the same exact level. So tells you how much has happened in rates over the last 2+ months. Not a whole lot, but that's where we are. That's the big spot, in my opinion, is kind of that 281, 282 area. And we'll see if the market can resist there. That could be part of the dollar story. I don't know. You know, it's with dollar, it's not just about the rates in the US, right? It's about rates in other places. It's about it's the relative story. So it's about rate differentials. It's not just, you know, what the US rates are doing, right? People sometimes get confused because they're like, well, what the hell? You know, rates are tanking here and the dollar's still strong. Well, yeah, because they're tanking everywhere else too, right? So in this case, if you're trading bonds, you know, pay attention to 10-year 281. That's kind of what I've got written on my chalkboard over here. All right, 30-year bond. Let's look at 30-year bond. So we're going to flip kind of around here. Right, bonds inverse to rates, of course. So we're looking, this is a little different. Now this is also 30-year. This is not, I like to look at the bond, but I also like to look at the 10-year yield. So, you know, it can get confusing, but looking at 10-year yield and 30-year bond. So 30-year bond also, of course, at a trend line from 1981. Had a little false break there for a big period back in late 2018. Had what I view as an impulsive advance to the upside, and I view this as a corrective decline. If I'm looking at the 30-year bond, I'm looking at big support around, say, 140, 130. Okay, that's going to be the low back here from July of last year. It's also, by the way, if we zoom in, we're looking at 2 equal legs down from the Jan 4 high. That was flash crash time, right? Okay, A, B, C, 200-day average is 143. There's the low we were looking at from August 1. I said July, I meant August 1st, 2018. You can see a little action there too. Low here, you call that a former fourth wave in Elliott. December 13th low, 2 legs at 42.19. So you've got really kind of a big zone here where you should be aware of support looming for the bonds. Okay, now we'll go to S&Ps, and we're going to look at a couple charts here for the S&P. All right, so if only life were this simple. Buy at the line, sell at the line. So that big drop that we had into Christmas Eve, I still don't understand what sickos dropped the market into Christmas Eve. Anyway, so we had huge support, and we are now on the opposite side of that because if you look at it, this is a fork. This is what's known as a shift fork from the 2009 low. It's not a channel. It's not a regular pitchfork. It's a shift fork. Don't really have time to explain that whole ordeal here, but understand that it's trying to identify the angles that the market's trading on, and it's done a pretty good job. And we are at a point right now where we should probably pay attention. So you can see the parallel here, right? We call this the 3/4 line, just like this would be the 1/4 line. And you can see all the inflection points that you've had on that, okay? I mean, since really 2016, it's been kind of crazy precise for the most part, all right? Even last year on October 11th, we had a huge rally off of it. Anyway, we're getting back into it. We're really close. We're kind of there. Horizontal levels there. Obviously, you've got the high from March of last year. Seems a little too ridiculous to say the high from March of last year is also the high from March of this year, but we're right there. You've got, a number of inflection points up from the summer. Of course, the December high, December 3rd, some sort of trade deal news, right? That went wrong pretty quick. And then, of course, everyone knows we just had the big trade deal news, supposed news yesterday, and it was the biggest sell the news thing ever, at least for the time being. So we'll see how that resolves. But my point here, all I'm getting at is that we are at a really, really important point on this chart, at least with the way I look at things, okay? I'm going to bring in a different chart of S&Ps because I want to show some breadth stuff, meaning I want to show kind of, advanced declines on the NYSE. So, all right, okay, so the magenta line here is your AD line, okay, your advanced decline line for just NYSE issues. Usually the market, the AD line tends to peter out before the actual market does, right? Well, we just had, if you look at the rally, and this in black is S&P, it just closes. But if you look at the rally from the low back on December 24th, for the first time, actually on March 1st, right, you had a divergence, a very slight divergence, but you did have a divergence. So you have, a lower high in the AD line and a higher high in price. That has not happened since the low. Okay, now these things can take some time. Think back to even last year, August, you got the high in the AD line, the high in price. Then you got a higher high in price in September and a much lower AD line. This is a much more powerful indication of what's happening as far as a turn. And then you had it again where breadth had really deteriorated and you were back near the highs again in October, and then we all know what happened, okay? But we did have that also back all the way back in January of last year. It was much more similar to what we had now, where it was just, a couple of days, or in this case, a couple of weeks, but back here was, 2 days, where you had a higher high in breadth with price on 123, 126, you had a higher high in price, but not AD. Okay, so, having the level that we're at, and also noting that you actually do have conditions in place for something in breadth for a top is important because we haven't had that yet, right? Trying to sell the market up to this point has obviously been the wrong thing to do. Well, at this point, you actually have a little more evidence in your corner that maybe it's going to work out. So I just wanted to bring that forth as well. And it's important, I think, also because of, where we are, on the chart, just the one I showed you before. Okay, so there's that. Finally, the last one I want to look at that I'm going to show you guys here is Shanghai Composite. All right, Shanghai Composite. We're looking at a pretty long-term chart here, weekly chart. Stick, save, and a beauty all the way back in 2016 and in 2018, and several times in 2018. Shanghai Composite is getting back to a level 200-week average. I would pay close attention. It's a little higher. You're talking about 3,200. Could be a little lower by the time you get there. All I want to, kind of point out, some people take issue with using trend lines that have been crisscrossed through, but I really don't. With this one, you've got the June 2005 low, okay, the 2013 low also in June. That was support in May and June, of course, of 2014. You can see the trading around it that took place in last summer, okay, support, broke through. It was then resistance again in September, and now we're well above it. So my point being is that I'd look at that as support, and that's going to be around 29.15, which is also the high from July of last year. So when I look at the Shanghai, I've got two levels that I want to pay attention to, essentially 3,100 and 2,900. All right, and that's that. So that's everything I wanted to share here, and time's kind of run out a little bit, but I hope you enjoyed the presentation. And the idea here is we're not trying to predict what's going to happen because we don't know. No one does. We are trying to look at conditions that set up for specific trades, whether that be from a volatility standpoint or a directional standpoint or both. Trying to put some pieces together, but also understanding that you can't put all the pieces together all the time. Like there's no time in market history, at least since I've been trading for quite some time, has that been more true. I mean, you've seen correlations break down like crazy over the last couple of years. All right, now correlations come and go, which is why it's most important to trade the chart that you are looking at that time, right? Trade the price on the chart in front of you. Don't sit there and try to say that, oh yeah, well, gold's doing this, the dollar's doing this, therefore, this market's got to do that, right? I mean, if I showed you this chart if you had advanced knowledge of this chart a couple months ago, and the Shanghai was going to rally, from 2,400 to 3,000, you'd be like balls long, the Australian dollar, and you'd be sitting there, probably negative on your trade. So, that stuff doesn't work all the time, or especially in these environments. So hopefully you got something out of this. For those that are SB members, I will see you guys tomorrow in the morning. And if you're not, then go to sbtradedesk.com. You can, there's a discounted offer for, for the first month. And this actually is what the update looks like tonight that I just published a couple hours ago. You can see that we've got different scans, weekly scans, daily scans, the levels that are kind of in play, watch lists for trades. There actually are no open trades right now. When there are, it says open trades. And then the charts of interest. Most of these, which I showed you, did not show you this one. This is a shorter term Euro chart showing 5 waves down. Aussie chart, CAD chart we looked at. This is a cable chart, but you get the idea. All right. Okay, so thank you so much for your time. I hope you enjoyed it, and have a great rest of your week. All right, take care. Jamie Setley here with SB Trade Desk, signing off.